by Chandan Agarwal, and he asks, if his investment horizon is more than 10 years, can he still follow an asset allocation of 70s to 30, 17 equity and 13 debt, or does he need to have 100% equity? In case of 70-30, is it better to invest in aggressive hybrid funds, or should he create his own mix of equity and debt?
Well, to answer his first question first, by all means, he can go right ahead with the 70-30 equity to debt allocation if that gives him a sense of comfort, because the debt allocation here would cushion the downside when the equity markets are witnessing a significant fall. And if that cushion helps him stay the course and not exit the markets in panic, then by all means, a 70-30 allocation can be suitable even for long-term goals of 10-year or even more. So that's on his first question. Regarding the decision about whether to go for an aggressive hybrid fund or build this equity debt allocation with equity and debt funds separately, well, let me provide the pros and cons of both of these alternatives so that he can take a more informed decision for himself. Taking aggressive hybrid funds first, well, what goes in their favor is convenience and tax efficiency. Because these funds are fairly convenient and a hands-off way to get this kind of an allocation. The rebalancing is put on autopilot, and an investor really does not need to do anything, periodically by himself. Also, all the rebalancing happens in a tax-efficient way because when a fund sells either debt or equity and reinvests that money in the other asset class, no capital gains tax liability emerges. So they are a fairly tax efficient vehicle in that sense. Now, the flip side of aggressive hybrid funds is that they tend to be relatively more expensive because if you look at their expense ratios, they are closer to or by and large similar to 100% equity kind of funds, despite the fact that they invest about a fourth of their money in debt products. So from that perspective, they tend to be a slightly more expensive proposition. In comparison to that, if we look at the proposition of maintaining equity and debt allocations separately, then of course the first point that goes in their favor is that this kind of an allocation can be created with lesser to overall expense ratio for this portfolio, because the debt funds in this setup would have lower expense ratio. Also, for a conservative investor who would rather want to stick only to the large caps, can well choose an index fund for the equity side of this allocation, and in that case the expenses of his overall portfolio would drop down substantially. So that's one point that goes in their favor. The second is that you can choose the best of both worlds. You can go about cherry picking the most promising equity funds and the most promising debt funds and combine them into a portfolio. But on the flip side, for this kind of an allocation, an investor would need to be much more hands-on, because he'll have to take periodic rebalancing decisions at least once a year. And while doing this rebalancing, one would also need to keep in mind the load and the tax applicability in mind, and try and do the rebalancing in a more tax efficient and a load efficient way. So all those decisions call for a greater time and effort investment on part of the investor. So with these variables in mind, he can really take a call whether he wants to go ahead, whether he wants to favor convenience, or whether he would want a more cost-effective solution, even though that might be a little more time-consuming.